everybody? I'm a couple minutes early, I think. We don't have to get going yet. Hey, Ron, good to see you back in the room. Good morning, Cav. I don't know about you guys. My market got stuck in a range this morning. Good morning, Bob. Um, Playing that patience card. Playing that patience card. Um, What are we doing today? I don't know. What do you guys say we talk about a couple patterns, look at a few different things, maybe discuss advantages, how to recognize them. Um, Embrace the idea that the more times you do something, the easier it becomes. I think that's the goal here. So, news, we're through news, and it was a big dud. Not a lot of movement at all. Market was a little stuck, and it stayed that way through news. And then really nothing else going on. We've got crude oil inventories at 10:30 for you crude oil traders. I know a lot of you guys are doing that. And then at 1:30, Fed Chair Powell speaks, and they're anticipating a high impact response from that. So you want to be aware. Pete, you said, yeah, oil was painful. I saw your pictures. I think they did finally break out. They always do. They always do. Um, Good lessons there, right? Is they always do. And the worst thing you can do, I think, is try to anticipate the breakout rather than wait for the breakout. Um, you just caught a nice long, very nice. I caught a short after the NASDAQ broke out. So good stuff. Guys, that's it. We check news every morning. I don't see any new names in here. Of course, everything we talk about is going to come from the Nexgen page. Hey, Steve, all the indicators that we use, all the rules that I teach, it's all on the Nexgen page. But what we're going to talk about from the trading guide is, guys, we're going to talk about that high probability trade. That trade where each indicator on every chart agrees with the rules for the trade, where the triggers are the strongest. There's no termination conditions, nothing between you and your targets. And we talk about it every day because this is your foundation trade. This is the trade that teaches you to read your indicators. And that's really what we're trying to do in this room. My job is to teach you to read your indicators, is to tell you how to look at them and understand what they're telling you. And chart reading is the core. It's the beginning. Hey, Miss Trina. It's everything that we do. Chart reading is about 90% of your day. Today was a great example. Most of you just sat still for the better part of an hour or two, just waiting for advantages to come into play. Hey, good morning, Wayne. Waiting for that advantage of momentum, waiting for that clear path. And then when it finally happened, you were able to capitalize. So once you accept that there's a lot of doing nothing in successful trading, it becomes easier to be successful, I think. 10% of your day will be actually trading when the advantages are there, when the rules are met. So guys, we're going to learn to read the charts so that you can identify the advantages, so that you know when it's okay to trade, when the rules are met. The high probability trend trade is only 3 rules. That's it. It's rule number 1, strong triggers giving you the advantage of momentum. So each rule gives an advantage. Rule number 2, no termination conditions, is going to give you a clear path. And I'm going to pause right there and I'm going to remind you guys that don't believe it yet. Once you understand momentum and path, once you can identify strong triggers, once you understand how to identify a termination condition, you really have everything you need to be successful with this software. So that's the core and the foundation. And I really want you guys to give that your all and make sure that it becomes second nature. Rule number 3 defines your entry area. And rule number 3 is just an entry rule. It has nothing to do with momentum and path. It has everything to do with pinpointing the lowest risk, highest probability entry for the high probability trend trade. These 3 rules are a 2-chart scenario. Big chart, little chart. How's that for technical? The large chart's a really slow moving chart, guys. It's a broad stroke of a brush. It's difficult to see change. And honestly, it takes the first bar. The most current bar is all you need to identify direction, momentum, and areas. Rules 1 and 2 are met on the large chart. The large chart leads the way. Once the rules are met, or you could even say only when the rules are met, will you turn your attention to the smaller chart, the faster chart. And this smaller chart refines that broad stroke of a brush. It shows typically 20 to 30 bars on this chart, and all of those bars reside inside of the one bar, giving you your first two rules met. By using a refinement chart to pinpoint entry, you're able to reduce risk dramatically, and you're able to increase your profit potential. And the entry chart is for rule number 3. We use these two. You should ask yourself, who am I trading with? Who am I trading against? And if you're trading with the large chart, if you're following the large chart, if you're letting it lead the way, you're trading with the large crowd, the people that create trends and establish momentum and react at key areas. And it's just the path of least resistance. Your small chart is the fighters. It's the small crowd. And the small crowd creates what we call retracements. When the large crowd wants everything to go up, they push down, and vice versa. But the small crowd typically fails 70 to 80% of the time, which means that when you're using rule number 3 on that small chart, because the large chart rules are met, you put yourself in a position to really pinpoint where their failure is most imminent, and this becomes your entry for the highest probability trend trade. And the wonderful news is that if they're failing 70 to 80% of the time, it means that you've got the potential to win up to 70 to 80% of the time. And that's why we teach this trade first, because there is a confidence that comes from that memory of success. This class is designed to be a broken record. This class is designed to say the same thing day in and day out. And what you'll find is your first 30 days in this class, you're going to hear the same thing, but you're going to hear it differently. And eventually it'll stick. Eventually it's like, oh my gosh, that's what he meant. That makes sense. So we do that by learning the trigger rules. Hey, good morning, Roy. Good to see you. We're going to learn the trigger line of the Fibonacci rules for when it's okay to trade. And I love the idea that it's okay to trade when your rules are met. And it's okay not to trade when the rules aren't met. Rules describe a pattern. That's all the market is it's patterns. It's a memory. And that pattern needs to be proven to win more than it loses. And that's what we're looking at with the high probability trend trade. You guys have the ability to simulate. Please practice, take trades, get in, get out. But the way to get to where you want to be the fastest is do me the honor of posting your trades in the room. Show me what you're looking at. Tell me, even more importantly, what you're looking at. And if every time you post in the room, you talk about the momentum that you saw in your chart, you talk about whether or not you had a clear path, and you show me your entries and exits, it's a private session with me is the easiest way to say it. And I'll give you the exact same feedback that if we were on the phone in the afternoon and you showed me the chart. I don't hold back for class. We will talk about your chart read to make sure that you're understanding what the indicators are telling you, make sure you're reading them accurately. We will discuss your entries and your exits and make sure that you maybe had the lowest risk entry or the highest probability win. But the most important thing that you can do is write the whys on your chart. Tell me why you did what you did. Or even more importantly, tell yourself why you did what you did, because what you're doing is you're creating this recipe, this repeatable moment that when the trade is great and the advantages are there and you're writing out the whys, you're creating this correlation between what you see and what it means to you in terms of success. And it's those whys that are how you're going to build your trading plan. But until you can build a trading plan, I'm going to give you one. And we're going to keep it very simple. It's going to have 2 trades on it. It's going to have that high probability trend trade where each indicator on every chart agrees with the rules for the trade. And then it's also going to have what we call a medium probability trade. In a medium probability trade means that most of your indicators lined up for the trade. However, a small issue exists. And it's going to be your ability to read your indicators. It's going to be your ability to look at your charts and understand advantages that lets you know what the problem is. And it's going to allow you to manage it a little more assertively. So we're going to keep it really simple. 2 trades. First trade is only 3 rules. Your job over the next 5, 10, 20, 30, 60, 80, whatever, how many days, is to just learn the looks. Recognize the pattern is the easiest way to say it. And the fastest way to get there, believe it or not, isn't taking trades. The fastest way to get to where you want to be isn't entering and exiting the market. It's taking pictures. It's studying the individual rules being met so that you can always identify that rule being met. And it's also recognizing when the rule isn't met. And that's what's going to put you in that 90% and that calm, waiting for the advantages. So the spreadsheet is the second way to get to where you want to be. And the spreadsheet is just 100% based on the idea that repetition creates recognition. That when you see the same thing, when you do the same thing, that thing becomes second nature. It becomes easy. The market slows down and your pattern becomes very recognizable. So the first tab is the basic rules. Strong triggers, clear path, even the entry, guys. In the green section, you're going to take these individual rules, what they look like, and you're going to piece them together to create a trade. And if your goal is to trade when the rules are met and not trade when the rules aren't met, it's important to know both sides, strong triggers versus weak triggers, and clear path versus termination. The second tab is client trades. Let me back this over here. And this is when you guys post in the room and it's an amazing high probability trend trade, or it's the perfect entry, or all the rules met. So Bob posts in the room, he goes, Mark, check it out. I had that momentum that we talk about and there was nothing in the way, and the market pulled right back to an area inside of favorable large triggers that I'm like, oh my gosh, Bob, that is everything that we teach each and every day. That is that core. That's that pattern that I want people to be able to study, and I steal it. And I come to my spreadsheet and I drop that link in there and I do something like, I don't know, Bob's perfect long. And now what you guys can do is you can come back and study over 400 pictures of Nexgen users doing stuff with the software. There's how to define your entry for the high probability trend trade for both long and short. There's a very mechanical management beginner plan that I'm going to give you on the plan that's handed to you. And what you'll find is that the more study you put into this highest probability trend trade, you'll begin to recognize things in your peripheral. You'll begin to see patterns emerge off the charts that maybe you didn't notice before. Take pictures of them, and then take all of your pictures and begin to build your plan. So Bob's trade was perfect. It fit every rule. It had every advantage. It was an easy winner. Bob's going to drop that picture into the plan. And Bob's going to wake up tomorrow and he's going to study that picture. And he's going to say, wow, I want to do this again today. I know what my pattern looks like. And then you guys are going to have to learn how to manage these trades. I'm going to give you a management plan, but you may develop your own. And then those patterns that you see, those things that you begin to recognize, take a lot of pictures of them, drop them in the room, see if I have 2 cents to add on them, and start filling out the spreadsheet and make your sheet look like my sheet. And then finally is trade tracking. Every time you take a trade, drop it in this sheet and discuss the momentum and the path. Really focus on the core, and you're going to see a correlation between having both and finding success. Trust me on this one. And then the big section here is feedback from class. And this is, I think, what sets Nexgen apart, is live for 15 hours every week. I'm in here, I'm looking at your charts, we're talking about your pictures, you're getting feedback. What'd you do great? Where'd you make a mistake? Where did your chart read go sideways? Was there a way to do it better? Was there something that you didn't notice? And guys, I get excited about helping you with your chart reads, I really do. But if you look at the feedback, More importantly, if you go back to the spreadsheet, we'll do this picture every morning, and you ask yourself, what worked? You're going to find that following your rules tends to work more often than it doesn't. And when you ask yourself what didn't work, well, you're going to start to see the tendencies you have. Maybe you're trading in determination conditions, or maybe you're jumping in too soon and you're just uncomfortable with the risk. Whatever it is, you'll begin to see it in the feedback. And if you look at this, it takes 2 to 3 minutes every morning to look at what you did to read the feedback. It's going to set you up for the day. It's going to keep you focused on the things that are bringing you success. And it's going to keep you focused on avoiding the things that don't seem to be serving you well. So over the next hour or so, it could be longer, who knows? I don't have an agenda. We're going to learn the rules for when it's okay to trade, meaning we're going to learn how to commit to having rules met, because rules are what provide the advantage. Your desire to make money, to win, to be an awesome trader has nothing to do with the results that you find. It's just a byproduct of the process, of the execution, of trading, the looks that provide that advantage. Guys, practice all day. Take 1,000,000 pictures, drop them in the room. Whether they are pictures of trades, questions about what you see, flood my room with pictures, please. And each one is going to get a little bit of attention. I will hand you the plan, and we're going to focus on the looks. And by the end of this first hour, you're going to walk out of this room with everything that you need to be successful with the software. So what we're going to do is just get to work. Interrupt me if you have a question, please. But let's talk about the indicators first. Let's make sure that you guys understand what it is that you're looking at when you open up your charts. Both large and small charts are going to have trigger lines. There's two different triggers. There are the small triggers. These are two solid lines. They work together. They're a fast-moving average, but that's really not important. Hey, good morning, Mighty Max. And then there's large triggers. They're dashed. And large triggers are slower. And these triggers are the same, whether it's a big chart or a little chart. It's small and large, and that's really all you need to know. Bonus points, if they're green, they're going up, and if they're red, they're going down. And that's about the easiest lesson that you're ever going to get. We're going to use trigger lines. You're going to use trigger lines to make sure that rule number 1 is met, to make sure that you have the momentum that you need to look for rule number 2. We're going to use them for rule number 2 to make sure that you're not trading into areas likely to stop the market. And then finally, you're going to use those big triggers, those large triggers, to define your entries, to get into the market where the trend is most likely to bounce and continue. So know the difference between small and large. They will work their way into everything that you do. And then there's also areas. Both charts have areas. And each area has a name. There's divergence highs, which is a magenta line that prints if there's a loss of momentum at a pivot. So anytime you hear the word divergence, I want it to be synonymous with momentum loss. Cyan line is the same line, just from a low pivot. You're going to see red Fibonacci resistance. You're going to see blue Fibonacci support, yellow 1-to-1s in a mid-band. In all of these areas, I just like to call them horizontal lines on a chart. On the large chart, you're going to be able to recognize where those people that move the market are most likely to make decisions by using these lines. On a small chart, you're going to be able to pinpoint where that small crowd is most likely to fail by using these lines. So again, you don't have to know any of the math that goes into them, but know the names for sure. And then we're going to break it down rule by rule, look by look. You're going to get everything you need to recognize advantages. And I'm going to encourage you, when you look at your charts, I want you to out loud scare the pets. I have momentum. I have a clear path. And once you know what's working for you or against you, you're going to know how to handle the situation just a little bit better. So rule number 1 on the large chart. Always on the large chart. Large chart leads the way. It must have strong triggers because we want the advantage of momentum. We want a market that's hard to stop. The only way to have it is to trade with the trend. The easiest way to identify a trend is look at the background color. If it's green, it's going up. If it's red, it's going down. You can make the decision to only trade with the trend. because the only way that you can have strong triggers is if all the colors match. You have to be trading with the trend to have that strength. In an uptrend, strong triggers means that your small triggers have broken above and away from the large triggers, the space in between the two. That's what lets me know that the odds are favorable for the market to continue up. Good morning, Miss Cindy. In a downtrend, the smalls have broken below and away from the large triggers. The space created between the two lets me know that the odds are favorable for the market to continue down. You can only have strong triggers if the small are green, the large are green, and the background is green. All three colors must match. If they don't, if the triggers don't match one another, or even the trigger lines don't match the color of the background, you don't have the strength that you're looking for to say rule number one is met. So separation is strength. Odds favorable for the market to continue in the direction of the trend. You're going to hear in the room all day long, see it annotated on charts, odds favorable momentum, OFM. Guys, that's the advantage that rule number one provides. And then when those small triggers work their way back inside of the large triggers, this is a weakening of the large triggers. And when you have weak triggers, anything can happen up or down. You don't know if it's going to go up or down. You don't know if those key areas are going to break or hold. Big retracements come from the middle of nowhere very often with those weak triggers. So as a brand new user, keep it very black and white. Let it either be strength, I'm going to look for the next rule to be met, or if it's weakness, I'm going to sit on my hands and wait for strength. And guys, it's cyclical. It comes back all day long. And I'm going to open up a large chart. This is crude oil. And you'll notice that strength pushes the market down and strength pushes the market up. And then look how the colors don't match. And that market seems to dance and it can't go up or down. Guys, this is the fight. This is the large crowd fight. The smalls are green, the large are red, and that market can't seem to do anything. But once they agree, once that space is there, and that market rockets all the way up to key Fibonacci resistance. And that's kind of what we're going to do, is we're going to develop a level of patience to wait for the best of the best. Is everybody good with that? That's rule number one. I still think that's probably the easiest rule to learn. Separation is strength. When they're together, it's weakness. Let's just focus on strength that pushes the market. Once you have it, we're going to make sure there's nothing in the way that could stop the market, that could create an untradeable bounce. We're going to make sure there's nothing in the way where the large crowd, buyers and sellers, may fight one another. So no termination conditions. We want that clear path. And this is the other 50% of the advantages that come from the large chart. What's a termination condition, they ask? Well, it's a horizontal line on a large chart. They all have the potential to be. So divergence highs, resistance, yellow 1-to-1, support, divergence lows. All of these areas are areas that could stop forward progress. And I want you to think of it, these are the areas where the large crowd are making decisions. These are the areas where the men and women who control the market are likely to enter, likely to exit, and likely to fight. So to define a termination condition, you're going to let that large crowd get to the area. And that's price reaches the area. The price bars, your dynamic Renko bars, are going up, and then price reaches resistance. And once price reaches the area, that's what sets off the decision-making process. And the reality is I don't know what the decision's going to be. I don't know if they're going to break the area. I don't know if it's going to create a big, ugly, untradeable bounce. I don't know if it's going to set off one of those fights where they just can't seem to figure it out between each other. And I don't know if it's going to reverse, but those are all possibilities. And I don't have to know. I don't have to predict, because when price reaches the area, all I have to do is ask myself, where are my triggers? And if my triggers remain below the area, it's a termination condition. And rule number 2 is not met if there's a termination condition present. So all I need to do is not trade into the area. Wait for the reaction rather than trying to predict. And then from that termination condition, all the triggers remain below. The market reverses. Those large triggers go from green to red. Guys, if that happens, if you get a termination condition and it reverses the market, we call that a strong top. And a strong top is the precursor, the highest probability trend trade that you could take. And a strong top is rule number one for the second trade on the plan. So know that when the decision made at that key area was so impactful that it reversed the market, gave you your rules met, man, that's one of the highest probability trades you could ever take. And then the sellers are in control, and then price reaches support. And once price reaches support, we're done with price. That sets off the decision making. Your triggers are what's going to tell the story. And it could bounce, they could fight, it could reverse, it could break. I don't have any idea. But if my triggers remain above support, support's a termination condition, rule number 2 is not met, I need to make the choice not to trade into that area because this area could stop the forward progress. And guys, that's the very easy approach. Anytime price reaches an area and the triggers remain above support, below resistance, sorry, I'm trying to find my charts here, it's okay to do nothing. And we'll just back it up a little bit. That's a much better view. Resistance holds. Support holds. Support in yellow 1-to-1s hold. Resistance holds. And then you'll notice that every time the market broke through here, it seemed to do it with momentum. It seemed to do it with that giddy up created by the large crowd. So price reaches, no triggers break. Sit on your hands, wait for the reaction. If it doesn't reverse, then it's probably breaking. But you don't have to hope it breaks, you can let it break. So this kind of shows what it looks like when an area breaks. First, it's a termination condition. Every time you reach an area, the triggers are below it, sit on your hands, wait for the reaction. That's the best thing to do for most people because it's just easier. If the area is actually going to break, if everything is truly going to get to the other side, you're going to let the trigger lines tell you the story. The same way they told you no trades into the area, they're going to let you know that your path is clear. So once the small triggers and the large triggers break above resistance, both lines of each, then that area is considered broken. You'll see that resistance behaves as support. And guys, your path is clear and rule number 2 is met. And with that momentum, you're going to go look for entries. And your path is going to remain clear until you reach the next level of resistance. And then you start the process over. So again, new users, let it be very black and white. You either have a termination condition, all the triggers are below the area, or your path is now cleared. All your triggers have gotten above the area and you haven't reached the next line. And then what that is going to do for you is that's going to open the door for your second trade. That's going to open the door for what we call the 50-50 trade because 50% of your triggers will have smashed through the area, but 50% will have not. And when you have this look, as long as there's odds favorable momentum, as long as there's those strong triggers, guys, this fib has the potential to break. It's not broken because both sets of triggers aren't above it, but this potential opens the door for the second trade, that medium probability trend trade. But you're going to have to manage it assertively because it's only potential. And it happens going the other direction. Price reaches support, the triggers remain above, sit on your hands, wait for the reaction. That potential is awesome, but it has to be managed assertively. And then the path isn't clear until both small and large get below. Support behaves as resistance, the path remains clear all the way up until you reach the next area. So once again, the potential to break, but it didn't. Weaker triggers, there's your retracement, indecision, and it bounces. Notice that 8 o'clock fib update gave you Fibonacci support with all the triggers above it, and then the market reverses. That's a strong bottom, and it takes you with all that momentum all the way up to Fibonacci resistance. So can you guys give me a Y in the room if you're with me? Price reaches, triggers don't break, it's okay to do nothing. It takes the small and large getting to the other side. And then, guys, there's going to be times. Here's the bummer. There will be times when your path isn't clear because areas are stacked, because it's rattling in between a couple fibs. And, guys, this is 90% of your day. It honest and truly is. 90% of your day is doing a whole lot of nothing because there's nothing to do. I believe that S&P gave a prime example of how rule number 2 can keep you out of indecision, about how those colors not matching keeps you out of indecision. And guys, this was a 45-minute period where there was absolutely nothing to do in the S&P. Do you see it? Because these lines were there. That resistance, oh my gosh, that is from 4 a.m. the previous day. Guys, it's a key number. And you know it's a key number. And rule number 2 keeps you away from those avoidable losses. But it's also going to keep you patient. It's also going to put you in that, man, there's nothing to do stage. And it's okay. It's all right to do nothing. The people that tend to make the most money typically take the fewest trades. It just happens that way because they're patient. They're waiting for their advantages. The futures markets trade billions, guys, every day. If you can capture $400 with momentum in between fibs, not trading into fibs, that's a 6-figure income. And that's a pretty nice income based for 5 or 6 minutes of actively working in your life. And that's termination conditions on the large chart. This one had the potential to break with all that momentum. And then, guys, your small chart gives you a heads up now and then. Your small chart shows some of the change that you can't see on the large chart. And there's one termination condition that I will accept on the small chart, and that's 3 divergences in the same price range. Remember, divergence is nothing more than a loss of momentum. And if your small chart loses momentum 3 times in the same price range, and we're going to define that same price range the same way we define a broken area until the small and large triggers get below these divergences are in play. But if the small and large get below, well, then that support begins to behave as resistance. Those divergences go in the rearview mirror. Guys, this is the only time, 3 divergences in the same price range, that I'll choose not to look for an entry because I know that the trend could be ending. But if my rules are met, if I have momentum on the large chart, if I have a clear path on the large chart, I'm going to go to the small chart, that refinement chart. We're going to break down that single bar, and you guys are going to define where the market is most likely to continue with the prevailing trend. And you're going to do that with such accuracy that you're going to use a limit order. And that limit order means that you're waiting for the market to come to you. You're not chasing it. You're actually going to wait on what's a little retracement or that fight from the small crowd. And when you're going to use that limit order to buy or sell the fight, the retracement, and you're going to do it at an area, at a fib, at a mid-band, at a yellow 1-to-1. And the most important part of this rule is the idea that those areas must be inside of triggers. Because price returns to the large triggers, guys. Whether it's a small chart or a large chart, price tends to return to the moving average. So on a small chart, price is very likely to return to the 5-1 large triggers. On a large chart, price is very likely to return to the 13-2 large triggers. So since we have 2 charts, we have 2 spots where it may retrace. You're going to use these triggers to define the area, the zone, the range where that retracement is most likely to go, where that down push is most likely to continue pushing down. So trigger lines will define the retracement, large trigger lines. You can increase accuracy by insisting on what we call favorable large triggers. And favorable large triggers mean that the large triggers from the large and the small chart are overlapping. And they're both on your entry chart, so you'll see them literally overlapping. And we call this favorable because it's the smallest location where the retracement is most likely to go. And we call them favorable because it's going to reduce your risk dramatically. It's going to increase your accuracy. And you will have the smallest little spot where that market is most likely to bounce as long as you have an area inside. So rule number 3 is we're going to buy or sell a pullback. In this case, buy a pullback at an area, fib mid-band yellow 1-to-1, inside of triggers. And that's the recipe. Write it on your charts every time you take an entry. And it's going to look like this. We're going to break it down. Once the rules are met on the large chart, and in this particular instance, your large chart is going up, your large chart has odds favorable momentum, and your large chart has absolutely nothing in the way. The large crowd has thrown 32 flavors of giddy up to the north side. And your small chart is going to reflect that. Your small chart's probably going to have odds favorable momentum up. And your small chart is going to have triggers up. And it's going to be screaming. And it's going to be screaming without you because your rules aren't met yet. So what we need here is we need that fight from the small crowd. We need a reversal bar. A reversal bar is just a down bar that prints after all these up bars. That's all it is. And what it is it's the beginning of the pullback, the beginning of the retracement. It's the start of the fight from the small crowd. So we know price tends to return to large triggers. And I have large triggers and synthetic triggers on my entry chart. Synthetic is a fancy way of saying the 13-2 large triggers. So from the highest line of the large triggers to the lowest line of the large triggers, this is where the market is most likely to retrace. This is where the down bars are most likely to continue going down. And it's a pretty big box. And the tighter those triggers are, one on top of each other, well, that's going to help with accuracy. The closer they are to that favorable large trigger look, the smaller this box becomes. But trigger lines aren't an entry point. Trigger lines just show me where those down bars may go. Entries come from areas inside of triggers. And areas can be Fibonacci lines, support or resistance. It can be a mid-band, or it could be yellow 1-to-1s. And then here is the most important part. They need to be inside of that retracement zone. They need to be inside of triggers. So this box on this chart is 2 ticks wide, guys, and it's from the highest area to the lowest area. And the recipe is the same both directions, from the highest area to the lowest area. These yellow 1-to-1s, well, they're not inside of the retracement. That's not a part of it. And this box defines where the market is most likely to bounce and continue with the trend on the large chart. This box defines where the small crowd is most likely to fail. You're going to study it and believe it, which means that you're going to activate a limit order 2 ticks above that highest point of support. And you're going to say, come get me small crowd. And guys, it's 2 ticks above the highest line because your large chart is going up. It's going up fast, and there's absolutely nothing in the way to create a bounce. We're not going to hope they can push to a lower area so that we can save a couple bucks. We're going to catch them on the way to that area in the retracement zone. And guys, this is it. You've done all you can do at this point. My brother used to always say, the only thing in regards to the market that you will ever be in control of, the only thing you have a say in is whether or not your rules are met. That's it. And then everything else is just up to the market. But here's the cool thing. If the market gives you an entry, if price reaches your order 2 ticks above the area inside of triggers, well, you're in a long position. You just bought the market. And you bought the market, and you have the advantage of a market where the odds are favorable for it to continue up because of strong triggers. And you have a market that has a clear path because there's nothing on that large chart, nothing in the way. And you have the advantage of having entered right where the trend is most likely to continue based on a pattern that's provable, repeatable. And guys, this is your high probability trend trade entry. And by learning this entry, you've learned to identify strong triggers. And that advantage is always an advantage, whether you take a trade or not. And you've learned to identify termination conditions. So now you know when not to trade into these areas. And you have the advantage of pinpointing right where the market is most likely to continue, and you're going to develop the confidence to enter the trade right there. So we're going to go through long and short entries one more time, guys. The reversal bar begins the pullback. The reversal bar is not your entry. It sets the searching for the entry in motion. You're going to define where the pullback, the retracement, the fight's most likely to go using the large and synthetic triggers, but you're going to define where it's most likely to bounce using the areas within. And this creates a window, if you will. I call it the window of opportunity. My brother used to call it the woo, but it just reminded me too much of Ric Flair. Guys, from the highest point to the lowest point is where the market's most likely to bounce and continue up. Your job is to activate a limit order a couple ticks above it, to say I'm not willing to try to save a couple pennies, but you're going to risk losing a lot of dollars. And the great thing is that once you understand the concept that the triggers define the retracement zone, that the areas define the bounce spot, you'll learn to ignore anything beyond the triggers. Anything beyond the retracement zone, anything beyond the areas most likely to create a bounce. And any line beyond those triggers on what I call the wrong side of the triggers, guys, that's not a part of the equation. That's not an entry. That's not in the window. That's actually where the market should not go if it's going to be successful. The advantage of rule number 3 is lost once you get beyond the large and synthetic triggers. Reversal bar begins the pullback. Trigger lines define. They are, Pete, I was going to announce that a little later in the day, but you're absolutely right. Markets are closed, which means that I'll be doing something other than teaching this room on Friday. The room, it'll still be open for you guys, but we won't be teaching. Reversal bar starts the pullback. Triggers define the retracement zone. Areas within define the entry. Any line on the wrong side of the triggers is not a part of the equation. This is where the market should not go. This is where your advantage of rule number 3 is no longer in place. And by defining where the market is most likely to continue, you have inadvertently defined where the market should not go, guys. This is your initial stop placement. This is the first time we even approach the idea of management. Because your initial stop placement will be placed 4 or 5 ticks beyond the trigger lines, where the market should not go, where the advantage of rule number 3 is no longer in place. And what's great is it means that you'll take smaller losses. You can eliminate hope and you can keep it a little bit logical. I always feel like the bearer of bad news when I say this. Your stop will get hit. You will lose the perfect trades. I did it this morning. It happens. 20 to 30% of the time, if you're following the rules for the high probability trend trade, you're going to get stopped out. It's just a cost of doing business, guys. It's a normal part of a positive equity curve, and it's 100% acceptable. And the key is making sure that you're taking the correct losses, that you're taking the losses that had momentum, that had a clear path, that pulled back to the areas inside. And guys, every now and then the small crowd's got to win. But what you can do is you can study this pattern. Every time the rules are met on the large chart, whether it's a clear path or the potential to break, if you scroll back historically and see one of these tails, what you're going to find is that if the rules were met, the bottom of that tail where you circled should line up with an area inside of triggers. And guys, you can go back, having never taken a trade, you can go back on your large chart, and we'll just take a look here. Momentum and potential, and there's a little tail. And let's see if we have a little more clear shot somewhere. Patience. Ooh, that market picked up, didn't it? We'll circle this one as well. This one had momentum and path on that tail. So what we're going to do is we're going to take those tails and we're going to open up a smaller, faster chart. and we're going to see where those tails actually show up. Whoops, and we're going to blow right by it because that's what I do. What time was that? That was recent. Man, a lot of slip sliding around on that market, huh? But look at that. With the momentum and the potential to break that divergence high, pulled right back, 2 ticks above support inside of triggers. That's your pattern. And if you scroll back to the next one, man, that market really bounced off the open, didn't it? The next one's not quite as pretty. Those areas are on the wrong side. 3 divergences print. Guys, that may not be your trade because the rules weren't met. The pattern isn't true. If we scroll back a little further, there's one of those bars, there's one of those tails, and it pulls right back to support inside of the triggers. So what we're doing is we're creating a little recognition, guys. We're creating a little bit of trust. We're learning to believe the idea that with momentum and path comes opportunity. That with momentum and path, you're going to find a way to get paid. What did that one look like? Is everybody following me? I mean, holy smokes. Can you guys give me a why if you see what I see here? Large chart, smalls are separated from the large, space between, hasn't reached the divergence high, has cleared the previous fib, pulled back to the mid band right in the retracement zone. Ladies and gentlemen, this is what we talk about every day. This is your look. That's your high probability trend trade look. And I'm telling you, if you got in at 70 and you exited, I don't know, on a reversal bar at 07, that's $370 worth of movement, guys. That's an awfully good move. That's pretty solid day. So you've got to study it. You've got to learn the looks. They've got to become easy. And I'm going to say it again. The easiest way to learn to read your charts isn't taking trades, because trades don't set up that often, right? It's 90% weighting. So go take pictures. Take pictures of strong triggers. Take pictures of weak triggers. But take the time to write. Why are they strong? Why are they weak? Why is this a clear path? Why is it a termination condition? And guys, start loading that spreadsheet with your pictures. It takes about a minute to take a picture. And I'm going to show you. I'm going to open up my large chart and I'm going to make it big. And I'm just going to take a picture. And I want you to see something. Smalls above large. Space. Colors match. What do you need to do? Colors match. Rule 1 met. Momentum. Odds favorable momentum. Look for rule 2. I don't know, what was that? 18 seconds? I know I type fast. Grab that link, open up your spreadsheet, and drop another one in there. Another picture of strong triggers. And guys, you're not going to be able to take 25 pictures of strong triggers, taking the time to annotate why they're strong triggers. You're not going to be able to do that and ever make the mistake of trading weakness, believing it's strength. And you're never going to think you had a clear path when it's a termination condition because of the pictures and the annotations. As you go through that little drill, this is the high probability trend trade checklist. This is going to give you pictures to police yourself, to make sure you're taking the correct pictures and annotating them the right way. This checklist starts with a strong top or bottom, which is that no triggers through termination that reverses the market. Not mandatory, but definitely adds warm fuzzies to the mix. It asks about the momentum. And guys, it's either momentum or it's weakness. It's your job to learn the difference between the two so that it becomes easy. Rule number 2 says that you can't trade into a termination condition. It says that it can't be the potential to break, that you must have a clear path. So make sure you understand what it looks like to have a clear path. And then defining your entry Great entries is the first step in management, because when you understand where the market is most likely to continue, you understand where the market should not go. And these pictures go all the way down to showing you where to put that limit order. The second page is the high probability trend trade checklist. Just for you guys that are wondering, I trade with a checklist on my desktop as well. I have a very specific set of rules to get me into a trade. And when I see them starting to set up, I begin to police myself. And I go through the same process you do of asking myself, do I have the advantages I need to take a trade? This also gives you something to write on the charts every trade you take. So you could say, did I have odds favorable momentum, right? And then answer the question on your chart. Describe it. Did I have no termination conditions? Did I have an area inside? And guys, if you're answering yes to each of these, nobody's ever been able to do that and do worse than 70%. And remember, the goal is to put more money in the account than the market takes out. Trading patterns that have been proven to win more than they lose is a great way to do that. So I'm going to give you guys the KISS plan. I promised you everything you need. And the KISS plan is the core of that. The KISS plan is a stepping stone in your learning journey. And I've been contemplating changing that because I believe wholeheartedly that you won't ever need to go beyond the KISS plan. You probably will, because you're brilliant, because you're going to see other things, because you'll find other ways to use the software based on everything that you've learned from the KISS plan. But I don't think you need to go beyond it. This plan is designed to optimize your chances of success with the high probability trend trade. As a new user, as you're learning to read your charts, guys, this gives you the opportunity to make a little money, or at least have the potential to win more than you lose. It's going to be through the simulation, through the study, through the class feedback, through continuous practice. Whew, sounds like work. The work you do, you'll be empowered to craft a plan tailored to your personal goals based on your experience reading the indicators. Guys, when you can read your charts, you're going to see things. You may find a new way. Hell, some of you teach me things, and I see patterns that come from you guys. And it's awesome because we all see things differently. But the one thing, or the two things, excuse me, that you have to know before you get off that simulator, before you go to test your plan in a live environment, you have to know why you're going to enter a trade, and it has to be clearly defined. The idea is that the answer is because my rules are met. And my rules are just a description. That's it. I'm describing a pattern that has been proven. And proven is in all caps, guys. I don't want you to take my word for it. I want you to say that Novak fella is probably a Yahoo. I want to go circle those tails. I want to test this pattern. I want to research this methodology. I want to prove to myself that it wins more than it loses. And when you do that, two things are going to happen. One, you're stuck with me forever. But the other thing is that you won't not enter. You won't sit on your hands when the advantages are present because you know that's your pattern. And it really takes the emotions out. And you're going to understand, this is my pattern. And if I take it 10 times, I'm likely to win 7 or 8 of them. And if I take it 100 times, I'm going to have 20 to 30 losers. And you begin to accept losers because the right losers are okay. They're a normal part of a positive equity curve. And that gets rid of the emotion, guys. But then you have to know why you're going to exit. Management is the second piece of trading. Entries are easy, guys. It's easy to push a button and get into the market. And then you have to do something with it. So why will I exit a trade? Well, I'll exit a trade because my profit targets are hit. That's the happiest reason to exit a trade. But I'll also exit a trade if my advantages go away. If I enter a trade at the area inside of favorable large triggers and they're able to push 4 or 5 ticks beyond those triggers, guys, I don't want to be in it anymore. I don't want to be a part of that trade. I want to say, you know what? My advantage is gone. I choose to exit. I'll wait for the next opportunity. If I enter a high probability trend trade and 3 divergences print on my small chart, I'll say to myself, well, this isn't my money anymore. This isn't my trade. The advantage is gone. I'm going to exit this position and I'm going to wait. I'm going to wait for my advantages to reappear so I have the best chance of success. So by defining entries, guys, by taking these great entries, you're creating a very manageable trade. You're putting yourself in a position to win more than you lose. And then once you pull the trigger, once they get you at that area inside of triggers, guys, it's management time. Time to pucker up. So what we found is that for the average new user, management tends to be a little more difficult because of the emotions involved. So I wrote a trading plan designed very much like the entries to remove the emotion. Doing my best. Uh-oh. Take care, Ron. I hope you get them figured out. So the management plan and the KISS plan, it's based on 2 contracts. And each contract has a different role. The first contract is going to teach you to get paid. And I think that's the most important concept any trader could ever learn, that's the goal. The goal is to get paid. But the second contract is going to teach you to trust your large chart, to learn how to hold for a little bigger moves. And the KISS management plan, guys, you're going to understand and trust stop placement, and it's going to focus on getting you paid. And then you will probably create your own management plan based on your experience reading the indicators. But until you can do that, the KISS management plan is 100% dependent on your study of entries, being able to enter the market where the market is most likely to continue. And it's just if then. Again, we're trying to remove emotion best we can. If my entry is 2 ticks below resistance inside of triggers, there's actually 3 G's in there, triggers, then the initial stop is 4 to 5 ticks beyond the triggers. And this is where the market shouldn't go. And the great thing is that you're going to know your risk before the trade is ever entered, which means you have to accept that risk before the trade is ever entered. Because this is where the market shouldn't go. A stop placed inside the triggers is where the market is most likely to retrace. A stop placed below areas inside of triggers is where the market is most likely to bounce. And that's a horrible spot for a stop. Your stop needs to go where the market shouldn't. And if you're not comfortable with $150 worth of risk, as there is on this trade, your best option may be to just simply not take the trade, to wait for one with lower risk. Your targets are predefined at $100 and $200. If they don't hit your stop, well, then that means that they started down in the direction of your trade. This reversal bar prints in the direction of your trade. You're going to redefine where the market should not go. Your new stop will be 2 ticks above that reversal bar. Because this down bar is confirming that the market is now moving with the large chart trend. The market is now going with the large chart momentum. The market is moving in the direction of the large chart clear path. And it's coming from the area most likely to create a bounce. There's no reason to put any extra risk on this one, guys. 2 ticks above that bar is exactly where the market shouldn't go if it's going to continue down. And your risk has gone from $150 per contract to $30 per contract. And it's not unusual to see you guys take these amazing entries, embrace that new stop, and even if it fails, get out of there with a $20 or $30 loss as opposed to a $300 loss. So guys, once this prints, new stops in place and you're sitting on your hands. Targets haven't moved. So if they don't stop you out for a small loss, well, that means that they went to your first target. And if price reaches your first target, guys, 1 contract is automatically removed. That first contract teaching you that profits are the whole goal of this thing, accepting them, pulling it off, and then you're going to move your stop to break even. And you're going to let the second contract do its job, because now you've just been paid, and that's success, and success breeds confidence. And now you have absolutely nothing to lose on this trade. And guys, this is such an important part for brand new users, because it's that second contract that's going to help you remember that the only reason you took this trade in the first place is because of the large chart conditions, because of that momentum, because of the clear path, because when your large chart looks like this, it's hard to stop. So you're going to have zero risk. And if it goes another $100, it's going to hit your second target. And that's a $300 trade. And it's a $300 trade on the most mechanical approach to trading that I could ever teach you. And guys, $300, believe it or not, is a pretty outstanding day if you stop trading at $300, because $300 a day, if you break that down, 252 trading days a year, guys, that's a $75,000 a year. Find a way to add $100 to that and you're in six figures, guys. But you've got to learn the basics. Focus on the basics. So I promise you guys everything you need. So in the room right now, I'm dropping in a zip file that says everything you need. And that zip file, inside of it, contains the Chart Reading 101. It contains the high probability trend trade checklist. It has the KISS plan. It even has the PowerPoint that I used to teach each and every morning. I'm going to drop my spreadsheet in the room one more time. So now you have access to my spreadsheet. I update it almost every day. It's already been updated today. The only thing that Nexgen really can't give you is the experience. So you've got the rules. You know how to identify them individually. You have the ability to study them. You have a place to study them. You have the ability to simulate, to practice, to post in the room, to tell me what you see, to make sure that you're reading it correctly. You have a plan, a simple plan, a plan that's been proven to win more than it loses, and it even helps you learn how to manage your trades. The only thing you guys don't have is experience. And that's okay, because experience comes with time. And that's what the class is designed to do, is to lay that foundation, to give you that core, that momentum, that path. And then you get to grow just a little bit each and every day. So as we go into the second hour, I'm going to share this, guys. The key to everything that I teach in this room, the key to finding success with this software is building a foundation. Your foundation is momentum and path. And then every day, grow a little bit. Every day, get a little smarter. Every day, get a little bolder, a little more confident, a little more comfortable. There's a Japanese philosophy called Kaizen. And Kaizen is the idea that instead of trying to be perfect instantly, allow yourself a little bit, 1% better every day. And what happens is you end up where you want to be if that's your focus each and every day. So for you brand new users, I blanket you with very conservative rules, recognizing advantages, and I hand you a solid plan that optimizes your chances of success as you learn to read your indicators. So for you new users, all termination conditions are bad, and no momentum is bad, and being on the wrong side of the triggers is bad. These are blanket rules because they increase the likelihood of success, and that success is going to breed confidence and keep you focused on the things that are bringing you that success. They're not always bad, guys, and you're going to see it in this room a lot. You're going to see a lot of exceptions. You're going to see more experienced users that are seemingly breaking the rules, but they're not breaking the rules. They're following their rules. Trading is an individual sport. The more time you spend with the software, the more you're going to see. It just works that way, and it opens doors for you. So one of my favorite phrases, you must learn the process that yields the results. You must learn to follow the recipe because the results seem to follow the process. That's where the KISS plan comes in. If you keep it that basic, if you follow simple rules and you're okay not looking for all the trades, only the best trades, guys, you can find an extraordinary level of success. Even as a brand new user, I've watched it over the years. I've watched individuals get funded in those prop firms following the KISS plan in their first 30 days with Nexgen. And the further you deviate from the simple, the longer it seems to take you to get comfortable with the basics, guys. So question everything. I don't know, Lonnie. I drink a lot of coffee. It slows everything down. I haven't really watched it. Is the ES truck in today, guys? It was stuck earlier, so it may have a little giddy up now. Guys, question everything. And I really can't stress this enough. Question everything that you don't understand. Seek clarity on everything that you don't understand. And Wayne will back me on this. Challenge me if you disagree with my feedback. Challenge me on it, but challenge me with facts, challenge me with pictures. And guys, we'll go back to the basic lessons to make sure that you're seeing things right. And I am going to insist that you give yourself a little bit of grace. Yeah. Wayne, you love to challenge me. I love it though. And you win every now and then too. Guys, question everything. But remember that you're new. And it's okay to be new. And it's okay to make mistakes. And it's okay to not know everything. Because I know that you're all alphas. And in your given careers, it's Billy and Betty Badass, right? You're the one that people go to get the questions answered. You're a student now. Accept that. Be cool with it. So as we get into the second hour, this is what we're going to do. We're going to look at all the charts presented. We will stop off at the live market every now and then just to see what's going on. And every picture posted, we are going to address momentum. So you're going to show me your chart and you're going to describe the momentum that you see. If you are correct, high five, good job. If you've made a mistake reading your indicators, we will address it and how to identify momentum. And then you're going to let me know what you thought of the path, whether it was clear, the potential, or whether you traded into a termination condition. I don't judge you on right or wrong. I judge you on your chart read. If you trade into a termination condition, but it's right for you, that's great. But mention that you're trading into a termination condition. If you think you have a clear path and it's only the potential, once again, we'll go back and we'll create a lesson to make sure that you understand the difference between the two. Same thing with entry. Show me where you entered. And guys, I encourage you, show me where you exit too. Because there's a lot of great management lessons from start to finish. If perhaps you entered way up here, I'll help you understand how your risk could have been lower. If you jumped in late, we'll talk about how you had more room to your profit targets from the best entry. And again, I'm not going to judge you on your trades. What I'm going to do is I'm going to say, hey, here's how you could do it a little bit better. Here's how the risk could be less. Here's how there could be more profit potential. The same thing on your exits. And if you guys give me 4 or 5 pictures in the room, by your 4th or 5th picture, what you're going to find is that I'm going to start to recognize your things. I'm going to start to recognize the tendencies that you have. I'm going to start to recognize the successes that seem to come easy to you, and I'm going to recognize the challenges that seem to be hindering you, and we'll actually work together to work through some of the challenges. So, that being said, yeah, they're moving pretty good. That being said, we're gonna get into the second hour, but first I want to circle this. Does everybody see it? Momentum, path. What time was that? Whoops, I zoomed right past it, didn't I? Pull back to areas inside of triggers. Can you guys give me a why? I want to see somebody that took this trade. I want to see somebody that said, Mark, look at this. I have momentum. I have path. It pulled right back to the area inside of triggers and it went down and I made $100 and it knocked me out break even, but it's still a damn good trade. I took it again and rode that one down to the fibs. Because making money in between the Fibonacci areas with momentum is your highest chance of success. And guys, this is one of those ones where if you missed the first entry, they came back for you, which is always a good feeling. So I'm going to walk away. Right now, the S&P has odds favorable momentum, and this area has the potential to break. And there are, without a doubt, areas inside of that retracement zone. I'm going to walk away. You guys let me know what happened when I get back. Not a high probability trend trade scenario because the large triggers haven't cleared. This is medium probability. But the recipe for entry stays the same. Areas inside of triggers. I'll be back in 5 minutes, guys. Post them if you got them. let's get back into it. Lonnie, right click on your chart, and Morgan, the one thing Jason's doing to help people with this is right click, go to your data series, and drop it back to like 3 to 4 days. So what's going on is with all the volatility in the market, NinjaTrader is having trouble with the data. And that seems to be the easiest way to fix it, is to drop it back to 2 to 3 days. You know what's fun? Is calling your shots. What do you guys think? Odds favorable, potential to break. I drew a circle, and I drew it 1, 2, 3, 4, 5, 6, 7 bars before it pulled back to support inside of favorable large triggers and continued up to Fibonacci resistance. What do you guys think? It works, right? You have to learn this pattern, guys. And if you missed it, guess what? They came back for you. And I'm telling you, this is what we talk about every day. Every day. I cover momentum, path, define an entry. All you have to do is study it until it becomes easy, and you'll be floored at what you can pull off. That worked, Lonnie? Awesome. I'm going to find myself in a tech position here one day. And then look at that. No reason to go long into an area that could stop the market. No reason to go short into an area that could stop the market. And we have defined a range that the market needs to break out of so that I can have a clear path. If you're new with me, I'm going to tell you guys right now, I say the same thing every day. I really do. I talk about the same advantages. It's the same pictures. It's the same concepts over and over every day. All you have to do is learn them. Learn the concepts. Focus on the advantages. Find your patterns and enjoy the spoils of ownership, I guess is the best way to say it. And speaking of, Lance, congratulations. Welcome to the family, man. Mr. Dean sent me a message this morning and told me that you came on board. And I'm excited about that. So now we really get to work together and get you where you want to be. I'm so stoked, man. Good job. You don't hear me? Oh, but you don't hear me when I say the same thing. You do, Lonnie. You know, my wife and I were joking or laughing the other day. She goes, it's so funny how your spouse or the person that you look to for everything can say the same thing over and over and you ignore it, and then someone else comes in and says the exact same thing to you and you're like, oh yeah, that makes sense. And then you go tell your spouse and they're like, what the hell? Funny stuff. All right, bad top. Yeah, it is. Odds favorable, without a doubt. That's awesome. Who put that in there? Morgan, nice job. And then Jen, you cleared the mid band and traded directly into the one-to-ones, but it worked out for you. Good job. Little different approach, but with all that momentum and clear path on the large chart, you said, I'll just ride the momentum on the small chart. Nicely done, Miss Jen. It's a little different. You broke the chili dog rule. But the advantages were there. They were solid. You found a way. When you have odds favorable momentum and a clear path, you find a way. I love it. Great job. And I saw that little funded account there. Did you do that to show off? I hope you did. Different. You think I got sick of sitting still yesterday, maybe? Possibly, it happens. All right, normally wait for the large chart to form, but with a strong bottom, 3 divergences, I entered as soon as I got above the mid band and wrote it to the fib. So Pete, I was going to talk to you about this one. It's not a strong bottom. But Bob, this goes to that idea of the picture that I showed of letting the small chart show change. Because the rules for a strong bottom say that the large triggers have to roll from red to green, and they didn't. But I want you guys to see how brilliant Pete is. Pete says, Mark, check it out. Termination condition and 3 divergences on the small chart. The small chart is showing me the change that the large chart is just a little bit slow on. And Pete, it's perfect. After that 3rd divergence prints, I don't know why you believe being a tick above the mid-band creates an advantage. That doesn't make sense to me. Why not just get in with the 3rd divergence and be aware at the mid-band? Because if it's going to go down, you're still in the short retracement zone, right? At least down here, you can ride to the top of the zone and have time to manage. Because if this market is going to go down, you're entering right where it's most likely, that last spot. Great hold, though. Great momentum. And it's just me. I don't understand the 1 tick above or below. You're at the area. But you had every indication that that market was going to go up a little bit. Yeah, it probably was. It's a great trade. 4:30 a.m., huge spike. Prow. Somebody got excited, huh? And then, oh my gosh, you and Jen taking the same trade, right? Caught a little snippet on the way down. Always pulls back after a big spike. That's that retracement back to the mid-band, right? Odds favorable, nothing in the way. You jump in and you get paid and you get out before things go bad. I like it. You and Jen took the same trade. Nicely done. In cahoots. Are you guys on Messenger? I'm about to go. You gonna go? I'm gonna go. No, you go. I don't want to go. All right, Bob be the man. Well, yeah, he did. But Jen, you know what? He did the same thing you did. You traded directly into the 1-to-1s. He traded directly into the fib. You said, at least I'm going to get in before the fib. So it's okay. With this level of momentum and where you guys are, you just rode the momentum. Nicely done. All right, Bob. Why I took this trade. Strong bottom. I love it. Odds favorable momentum. Not yet. I love it. When it's going so fast, ride the wave, right, Pete? Not momentum yet, Bob. You're inside, but they're accelerating up. And what happened? Bad top. Hits the fib and nothing blinks. And I love this look. Hits the fib, nothing changes. Large triggers stay up, small triggers roll green. And Bob takes a perfect entry and says, man, from a bad top, mid-band holds, we're probably going up to the fib. And he just rides the wave again. Absolutely beautiful trade, Bob. Nicely done. Why he took this trade. Odds favorable momentum. Yep. 50-50. Yep. No divergence. Perfect entry. And just outstanding. Once again, great job, Bob be the man. Are you in a funding now? Did that start today? Great trading, Bob. 100% per your plan. Let's see who's next. Pete has a couple. Pete just showing, man, I'm not trading this nonsense. Tomorrow, I like it. Not trading a market that isn't giving me what I need. Did I mention I'm not trading a market that isn't giving me what I need? Guys, these are great pictures because what you're doing is you're saying my rules aren't met. I'll take a picture and remind myself that my rules aren't met instead of taking a trade hoping that the market does something the indicators say that it may not do. And Pete, these are some of the greatest pictures. And did you say that when it broke out of the range, you made money? That your patience, you didn't give it away, and then once it broke out of the range, you found a way to make money? Outstanding. Guys, the most successful traders I've ever worked with have a willingness to not be in the market. They have a desire to not enter if their rules aren't met. And you'll begin to see it in yourself and in the people around. All right, strong bottom again, Bob. You and the strong bottoms. And odds favorable momentum, well, that seems like a good reason. Clear path, well, for sure. Rules-based entry, absolutely. And once again, $300. And Bob, I noticed that today you're focused on getting paid. Is that right? You're focused on not suffering retracements. I like that. For those of you that are Apex traders, that's one of the ways to beat the system. You're killing it, Bob. Just don't change. Don't go changing to try to please me. Now some of you are singing it in your head. All right, Pete, let's see what you did. We got two. And there it is. I love this. After 3 hours of painful chop, it finally broke out. Triggers rolled up and separated. Odds favorable momentum. And Pete says, man, let's reward the patience. Outstanding. Great trade, Pete. Nice job. Great patience. Why do we do nothing when there's nothing to do? Because the next trade is coming. I think that's one of those things that should be written down on a piece of paper in front of you on your checklist. The next trade is coming. It's okay to do nothing. The next trade is coming. The market trades billions. I'm going to get my piece of it. So good. And then why you use trailing profit stops. Put it in the bank. Get paid. Get paid. What's the goal of trading? Get paid. And Pete, we're going to use you as an example here. When you believe the next trade is coming, that the market is not done for the day at 8 a.m., you are okay getting paid and waiting. And guys, it's easy to hope, right? I hope it continues up. Pete says to hell with that. From 07 to 26 is a 19 tick move. It's 190. That's $380 he pulled on those two contracts. And add that to the two here, guys. That's a third of his daily goal, and he didn't suffer any retracements because Pete knows the next trade is coming. Love that. All right, who's next? Dun, dun, dun. Wayne. I'm using sound effects here, sorry. 50-50. Odds favorable. You catch it on the way down. I don't understand your stop. That would be the only thing that I could say. Did you get slipped? The stop doesn't make sense to me. It looks like you could have had about an 8-tick loss. This says you have a 32, 30, 170 per, $340 loss. So, Wayne, if you have your ears on a 50-50 with divergence, it's okay to use the reversal bar for your stop placement. And this is one of those things. So I want to do this real quick. My brother used to do this to me. And as much as I hate the lessons he teaches me, they're all amazing. And he used to do this. He would, 100%. Is this where you'd want to enter a short trade? And of course the answer is no, right? You say, gosh, absolutely not. Why would I even think the market would go short this far beyond all of this? But in the heat of battle, you start thinking, well, maybe, I hope, I think, maybe that mid band is my saving grace on the wrong side of everything. And you end up taking bigger losses. And I think that the reversal bar, you could have mitigated a lot of damage on this one. In the heat of the battle, he don't miss. All right, who's next? Ron. Ron's already left, but we'll talk about it anyway. He says standard trend trade. I'll disagree. He took what's more of a momentum trade. Everything is down and his path is clear, and he says, you know what, I'm going to find a way. I'm going to find a way. And they try to go up and fail, so he catches them on the way down and makes a little money. Base hits pay bills, guys. One of the greatest phrases. Oh, next gen momentum trade, not trend trade. Yeah, I agree 100%. Guys, one of the greatest phrases in this room is base hits pay bills. $100. Did you know that $100 4 times is $400? And $400, 252 trading days a year is a 6-figure income. Your P&L doesn't know if it was $100 at a time or one trade for 400 or what. Remember that. You don't have to make all the money every time. All right, chili dog fail. So let's see where the chili dog was. Oh, yep. And Wayne, you took it perfect. You took it absolutely perfect. And I agree. The only thing that you didn't do is you didn't accept the loss of momentum. And one thing that I'll do, guys, if I notice changes in your trading, if I notice something, there's a lot of hope going on in your management plan. Your stops are bigger than I've ever seen you put them. And I don't know if you're studying something new, or if the flavor of success has made you a little overconfident. But that's not normal for you. You don't usually leave that much trying something new. Okay, so that makes sense. But guys, I'm not afraid to say that. I'm not afraid to say, Wayne, what the hell are you doing? Because Wayne's in my room every day showing me what he does, and I know his plan. And when he deviates, I go, hey, this seems a little different. Let's talk about it. Because he may not notice that he's doing something different, but he's like, dude, Mark, I'm working on something. And I'm like, okay, that's perfect. Let's work on it. Let me know if I can help. It's not working well. But you have to go through that process, right, Wayne? You have to know that mouthing off to the big dude usually gets you a rap on the beak. And if you never do it, you don't know. Yeah, you have to have data points. Amen. All right, just starting to get separation in the triggers. Divergence, mid-band outside of triggers, and it blasted right through. Whose picture was this? I like this one. This was Pete. Areas on the wrong side of the triggers. When I say that I think the most important language on entry is area inside of triggers, this is exactly why. Because once you get to the wrong side, once you get below the retracement zone, guys, you just don't know. You just don't know if it's going to bounce. You don't know if it's going to continue up. And the large chart look is good, Pete. It's a good look. But you can't define an entry. You can't define risk. And I think avoiding this trade, it shows a belief in the rules, guys. It shows a belief in the idea that as soon as the advantage is gone, it's okay not to trade. Nicely done, Pete. Nicely done. Whoa, we're almost to the bottom. That happened. All right, Wayne. Chili dog fail. Once again, perfect. No reason to give it back. I know you're working on something new. And then when price reaches the areas and the large triggers don't follow, beautiful execution. Beautiful execution on the way down to close the gap. So guys, the gap theory, and Wayne just expertly did it here. If price accelerates away from the large triggers, does everyone remember that price tends to return to the large triggers? Well, it's more likely to return to the triggers if price smacks into something solid. Wayne says, wait a minute, we pulled all the way to resistance. Those large triggers aren't following. Price is likely to close that gap. That's the gap theory. And here's the beautiful part, is Wayne doesn't say, I hope it holds. Wayne doesn't say, I wish it would hold. Wayne doesn't say, it could hold. Wayne says, let me get my small triggers down into the other side of those large triggers. And it's perfect. And the patience, Wayne, keeps you from getting run over twice. And it closes the gap right to the triggers. And when they get to those triggers, decisions will be made. And if it's coming from a bad bottom, Wayne, sometimes that decision is to continue down. So I like it. Great job on that one, man. Great execution. That is a prime example of taking a pattern and learning how to take advantage of that pattern. All right, Lance. Great triggers, clear path, made a mistake, didn't wait for the bar to clear resistance before buying, thought it did, too quick on the buy button. So were you trying that chili dog, Lance? With all the momentum, let the back of the bar clear and just hop in? Yeah, so great lesson there, right? And this goes back to what Wayne was saying. You got to have data points. And you've got to make the mistake so that you know how to do it. And then there you took it and they got you. And then here you just got in a little early. You're like, well, I'll teach them, and it worked out. Good stuff. I like it. And I think that the best part, I think the biggest victory in this loss is that you recognize the challenge, and now you're going to be able to find a way to work around it. This is the momentum trade. Termination, lower divergence, everything rolls, and you get a little snap back to the fib. That's pretty solid, Lance. That's advanced. That takes some reflexes, and you did it perfect with the momentum and the potential to break. Nailed it. Absolutely nailed it. Nice trade. And with all that momentum, it just kept going, didn't it? One thing you can do, Lance, if you want, is if you right-click on your small chart and go to data series, you can get them to plot those text and markers on that one. And I think for study, it makes it a little easier because you get to see all the conditions going on around your entry, as well as management. And if you don't want to, you don't have to. But I think a lot of the times, being able to see that entry over here, I don't know, for me, I think it just makes it a little easier. Over here, it's such a broad stroke of a brush, it just looks like that doesn't make sense. But over here, it totally makes sense. Good stuff. That's what you call guns a-blazing as you work your way into Nexgen. Bad top. Mid-band, gap theory, back to the fib, back to the divergence high. Guys, the S&P found a little range, didn't they? The S&P found a little range here. So now we're saying, okay, if my trigger lines get above the divergence high, I'll look for longs. If things roll and go down, I'll look for that clear path for shorts. And guys, this is, well, there we go. They're trying. They're trying. Let's see what they do. So I'm watching the trigger lines now, right? I'm not looking at price up here. I'm watching those trigger lines, and I'm saying, all right, let's see what we can do. Absolutely. Well, no, not if it's a mid-band and no triggers are through, Morgan. If it's a mid-band and the large triggers are a full bar away. Because what's the definition? The definition is a termination that reverses the market. And now it's a 50-50 with two divergences. And most of you said that's not my trade. Does that make sense, Morgan? Let's take this picture. Because this is when the mid-band happens, right? So what's a strong top or bottom? It's a no triggers through termination condition that reverses the market. Is it? In what capacity? Like trading into it? See? Okay. So you're creating your own rules. Watch this. So you created your own reality, right? I don't want to trade into a mid-band. Well, that has nothing to do with the rules. It's a rule that you created. And mid-band's not a termination condition here, and it broke. And the mid-band was a termination condition here, and it didn't. And it was a termination, and it held. So Morgan, I'm going to give you a little heads up on mid-bands. It'll give you something to think about. Okay? And let's spread this out a little bit. And this isn't 100%. And we're going to do it just like this. Whoops. Let me get my call out here. So guys, this is good study on patterns. If the market is coming from a bad top or bottom, the mid-band is more likely to create a bounce. I may be. I'm aware. So from a bad top or bottom, I will respect the mid-band because often it is the spot for more continuation down. Think trend trade. Does that make sense, Morgan? So if I'm coming from a bad top or bottom, then my awareness goes up on the mid-band. If I'm coming from a strong top, I still have to respect the gap theory, but it's less likely to hold. Strong top, look how it breaks through, right? Weak bottom pulls back up. Weak bottom pulls up and tries to go down. Weak bottom, mid-band holds. Weak top, fib holds and retests. Weak top. So it gives you something to think about. But man, if it's wide open, Morgan, and you're coming from a strong top or bottom, enjoy it. If you're coming off of a fib and you've got this look, let's say the fibs aren't there, look for an opportunity. Does that make sense? Does that help a little bit? Something to think about, right? I don't worry about trading into mid bands if those large triggers are screaming and I'm coming from a strong top or bottom. But if it is a weak bottom, I'm a little more aware. Because look at that. That's 50-50 too, right? Blech, not so great. All right, Pete. Like a little strobe light there. How far back in time will you count 3 divergences? This is about 20 minutes. So Pete, The idea for divergences is no different than the idea of broken areas. Once your small and large gets above this, it's in the rear view mirror for me. It's done. It's over. It's broken. It's history because the market's gotten above that problem area, just like fibs, just like divergence highs, just like one-to-ones. So let's find a small chart real quick. 3 divergences. Once my small and large get above it, clear path. This divergence is the first divergence. Once small and large get above, this one becomes the first divergence. Good question. That's okay. My brain fades too sometimes. All right, Wayne. Chili dog. Man, they keep trying to get you. Triggers. So Lonnie, always triggers. Triggers tell the story on termination conditions. 100%. Anytime, everything that I teach, Lonnie, triggers define. If you're taking this trade, this chili dog trade, that's not a Nexgen trade. That has a different indication. But if you're looking for a trend trade, trigger lines will 100% tell the story. Wayne has an interesting approach to it. Large charts, great. Small charts, not quite as great. But with the large chart look, you knew you had room to trouble, and you just took advantage of it, and it never even blinked for you. And the fact that you get in after the failure is even better. The buyers tried, failed, and you're getting in with divergence pushing down, large chart leading. I love everything about this trade. And you're also in on the right side of those fast triggers that rolled. This is a great trade, Wayne. Nice execution on that one. And then not letting the back of the bar not letting it clear, but taking advantage of momentum and doing great with it. Not a chili dog, just jumping in because of momentum. Does that make sense, Wayne? You can call it whatever you want, but if you're looking at the actual rules, you didn't let it clear. But let's just celebrate it. Momentum on 3 charts, how likely is that chart to stop? This one's perfect. Momentum. And then, Lonnie, this may be what's confusing you. So these people taking these jump-in trades, sorry, Jen. I answered it and just, wow, probably not going to revisit. Just kidding. It's no different. Let me do Wayne's and then I got you. Don't worry. So Lonnie, I think this is what may be confusing you. And let me show you why. So every day in class, we say that in order for an area to be cleared, both the small and the large triggers have to get above it, right? And that's what we say. So here it was a termination condition, and then this becomes a termination condition, and you never get a clear path. But guys like Wayne and Jen and Morgan and whoever else has taken this chili dog trade, what they're doing, and this isn't Nexgen taught, this is using the indicators and the understanding. What Wayne is saying, and Wayne, I'm going to put words in your mouth. I hope that's okay. Wayne is saying fibs are where decisions are made. If I let price completely get away from that decision point, as long as I have odds favorable momentum, I'll jump in and ride the momentum for small wins. Does that make sense, Lonnie? He's letting price bars get away from the decision-making point, but here's the deal. That's a different trade. That's just a momentum trade. That is nothing more than saying, okay, I don't happen to be near a decision-making point. I've got momentum everywhere. Let me take quick profits. Um, and you can see that with the potential to break, that chili dog never set up, but the perfect medium probability trend trade did. And this is one of the reasons why I think it's so important to name your trades. Because Wayne knows how to manage this trade that only relies on momentum, right? And then if he caught the 50-50, he knows that it's a different management plan. And if it's a high probability trend trade, he knows it's a different management plan. So understanding the rules that are getting you in, why you have them, it helps you manage a little more appropriately. But that's where the confusion comes in. This is a 50-50 look by Nexgen trend trade rules, but it does fit the entry rules for that trade that some of these guys are taking, the chili dog trade. I don't teach the chili dog trade. Well, it turns out I teach it every day. But Nexgen, it's not part of the Nexgen curriculum. And there it is again, and Wayne breaks all the rules. Wayne says, I'm not going to let it clear. You can't make me. Everything's going down, and I really want to be paid. And it works out, right? It works out. Chili dog trades don't usually come from the wrong side of the small triggers. They don't usually come with no momentum. They don't usually come with not clearing the area. So if I were like, oh, Wayne, let's really address it. Wayne took a low probability trend trade in a downtrend. Small triggers broke, large triggers didn't. He entered on a pullback to resistance inside of triggers. And then he wrote it down because everything said down. It's not a wrong trade, it's just different. But it's not that trade that he called it. It's not a chili dog trade. It doesn't. Because if you're naming your trades, the names have rules, right? This is I'm in a strong trending market. I'm 90% below the fib, and I'm taking the entry just below the fib after the retracement. It's a trend trade, Wayne. That's all it is. It's just not a high probability trend trade. It's a beautiful trend trade. Nicely done. Yeah, it's an awesome trend trade. And it's the Wayne entry. They'll let it go above and then let me catch it on the way down. It's great execution, Wayne. It's just named wrong, I suppose. All right, trend trade failed. Oh, we saw this one yesterday, Wayne. Do you remember? The fib update got you totally into a termination condition. Yeah, this is yesterday's trade. And then great job turning it around and riding the momentum up to trouble. I remember this one because that thing was sneaky. That thing was sneaky. It was hard to see on the large chart. You got bamboozled, flim-flammed. Perfect, Joel. Joel, termination that reverses the market was down here. It was good. And then odds favorable, 100%. No terminations, 100%. Area for entry inside of favorable large triggers, 100%. Joel, this is a sexy trade that didn't work. This is all the advantages. And the only thing that I think I would say is that 4 to 5 ticks below the triggers has you out about right here. And it's a smaller loss. And that's really the only coaching I could throw at this one. Is yeah, you put a bigger stop hoping. And that's it. And it's okay. That happens sometimes. But I want to show you guys something. If you use hope instead of logic for a stop, and let's say it cost you $50 here compared to what it could have been, Joel, what happens when that $50 today is compounded over the course of a year, right? That's 12 grand. That's a lot. That's 4 or 5 trades worth of commissions in a day. And that's if it only happens once. And I think that I'm not doing this to knock Joel around, But oh my gosh, this is precision, right? This is precise entries. Joel, you had it dead to rights. Perfect. 100%. Couldn't have done it any better. And because it was so perfect, and I know because it was so perfect, you thought, man, I'll give it a little breathing room. And I think that's fair. I think it's fair. Because it's 100% the pattern that wins more than it loses. And this one happened to be a cost of doing business, which is why adjusting your plan because of your emotions, because of your opinions, and I'm talking you collectively, not you specifically, when you adjust your plan based on the moment instead of just following the plan, it's almost like Murphy's Law. That's where stuff like this seems to happen. Um, and I am guilty as charged, 100%. I've done it. So there's your bad top. Morgan, what's most likely to hold? The mid band. Divergences help kind of prove that, right? Pretty cool though, isn't it? There's the pattern that we talked about. Did you guys change your days on the big charts too? I'm going to try it. I did it on my small charts to fix stuff. I didn't do it on my big charts. Wayne said I was missing stuff. That's why I'm going to do that while we look at Wayne's chart and see if that fixed it. Yeah, I think that's a good one. Wayne, smalls above the large, fast triggers up, and you say, this thing's pushing up. Let's see if it can push up for a small profit. Nice trade, Wayne. And what these HVA lines they are an indication of where the buyers rallied and said, I dare them to come back to it. And Wayne recognized a pattern here. Wayne says, check it out. I get a breakout bar. They define the highest concentration of buyers. My fast triggers go up. Well, if they pull back to that breakout bar, to those fast triggers up, I'm going to see if I can ride that wave. I really like the way you did that. Nice one, Wayne. And guys, if I say I like somebody's charts, it doesn't mean that I dislike yours if I don't say it. It just means that I like the way you read your indicators. I think that's pretty cool. Well, that's better on 6 days, isn't it? Now my fibs line up. Talk about indecision. There's that gap theory again. That's ugly. But once the large triggers roll, it closes the gap. And now they're in an indecision making point again. All right, guys, I'm going to go run a lap and take a break. We've made it through all the pictures. I'll leave you guys with the S&P. It's bouncing pretty good. If you have a question, please post it in the room. If you have a comment, if you need help with something, post it in the room, guys. I'll be back in about 5 minutes, and we will finish this day strong. Back in a minute. Back into that final hour. I don't know if that was 5 minutes or not. Then Jen, let me answer the question that I needed to answer for you. When are divergences broken? It's the same idea as areas. So let me spread this out a little bit. So this chart has multiple divergences, guys, and the first divergence prints right here. And as soon as my small and large get above them, this divergence is broken and it's no longer in the mix. So this becomes my first divergence. Small and large stay below. Second divergence, small and large stay below. Third divergence. So now I have a termination condition, 3 divergences. As soon as small and large get above that third divergence, it's considered broken and the count starts over. Does that make sense, Jen? Sorry, you almost let me get away with not answering that question. So it's the same idea as areas. Timing is not in the calculation, I think Pete said 20 minutes ago. No, yeah, so it has nothing to do with how long it's been. Whoops, I just accidentally closed out my small chart. Oopsie. Guys, if you ever close out a chart, if you accidentally X out of a chart, go to workspaces and close the workspace, but when it asks if you want to save it, hit no. And what that'll do is when you bring the workspace back up, it'll bring up both charts. And I'm going to see if it'll let me change that to 6 days real quick while it's loading. Hopefully it does without crashing. All right, Jen, let's see what you posted. Smalls inside a large, not odds favorable momentum. No areas inside of favorable large triggers. It pushes beyond the midband, but it is a strong bottom. I like it. And what we're looking at here, Jen, is a bad top, pushes right back to the midband, right back to support, and then Morgan once again, when's the midband more likely to hold from a bad top? And it's pushing up, and what you have right here, Jen, is the acceleration, and it's starting to go, and it's trying to break, but you don't have the perfect entry anymore. And this is one of those times where more experienced users might say, you know what, with this look, that it may continue up. Maybe if I get a reversal bar off that midband that's outside of the triggers, maybe I'll take a shot at it, but I'm going to manage it aggressively because I know that it's not perfect. And maybe the reversal bar gives you the ability to establish your risk, and because it's not high probability, you find yourself managing it a little more aggressively, getting to break even as quickly as possible. Whoops. Let's see. I'm going to crash my Ninja because I'm trying to do stuff while charts are loading. Rule number 1, don't do things while charts are loading. It never works out. There we go. So what did it do? It didn't work out, did it, Jen? It gave you a chance to manage if you chose to trade without momentum from the wrong side of the triggers, and then it died quick. So do you need the trade? Do you need a no momentum, no areas inside of triggers trade to be successful? No. But is everybody going to try it because they're bored? Most likely. It's a great look. And for you, Jen, I throw in that little option, right? There's other stuff. Post instead of trading, yeah. And then when weakness and everything gets strong, you chili doggers probably caught a short straight to support. Good stuff today. Trina's posting. Let's see what you did, Trina. Strong bottom, no triggers through. Can I tell you how much I appreciate that not only do you post strong bottom, but you also post why. Makes it easy. Odds favorable momentum. Why? Why triggers? 50-50. Smalls are through, large are not. You choose to take the entry at the area. Didn't see the divergence print when entering because you were focused on your entry. It happens. Beautiful entry, quick profits, easy money because of the strong bottom, because of the momentum, because of the potential to break. And you know what I really like about this is you said that could be a problem area. Let me get paid. It's a medium probability trade. And let's go through what happened here. Everything went down and hit support, and the triggers were weak, and it created a huge bounce. And Trina, I noticed that you didn't trade into the midband and resistance because of the gap theory, right? I can't go long yet. I'm into an area that could stop the market. And look at the reaction of the market. So the market comes back all the way to the large triggers, as price does. And what happened on that retracement? Does everybody see? I think the clinical term is not a darn thing. Your small triggers stayed up and strong. Your large triggers stayed up and strong. There's the reaction off the area. And then it continues up. This area, they've already tested it. They've already reacted to it. I love it. That 50-50 has a better chance of being successful. Andy, enjoy your 2 days, man. Enjoy your 2 days. What a great thing to do every now and then. I'll miss seeing your smiling face in the room, but I hope it's a good one. Oh, very good. Go see that grandbaby. I don't have any of those yet. I hear it's pretty cool, though. Enjoy your time off, Andy. We'll see you when you get back. Everything about this is spot on perfect, Trina. That one should go in. But I think that it's just a lesson. And since we've got an hour and no pictures, this is such a good pattern, right? Support holds. And here's the test. And that's the results of the test. So here's the test. Results are the buyers want it more. How's that for results? Which is why this trade had such a good chance of winning. And we are at that point where I start begging you guys to ask me questions. Still waiting on updates from JN, John Novak. He's been in surgery for about an hour and a half now. Probably another 2 or 3 before they have that back fixed up for him. Bad top. Morgan, there it is again. Straight to support. Straight to the mid-band area, right? If you were thinking about going short, you're going short into an area that could stop the market. Going short into an area that's more likely to stop the market because of the bad top. How's that for a cluster foxtrot, Charlie? We keep trying to go up and we can't, but we keep trying to go down and we can't. I don't know about you guys, when they can't seem to clear a path, I feel less confident on a 50-50 trade. I'm less likely to try to catch the breakout before the path is clear because clearly they can't seem to get anything done. When we say decisions are made at key areas, there it is, guys. There's the fight between the buyers and sellers right at key Fibonacci areas. All right, what can I do for you? I'm going to start going through old pictures. I haven't done this in a while. What's Nexgen been teaching for 30 years? Identify your termination conditions. If they hold, you can look for opportunities. If everything is strong, take a trend trade. Hit the next area. Wait. Is it going to break? Is it going to roll? If it rolls, look for longs. If it breaks, go back to looking for shorts. Guys, we've been teaching the same thing for 30 years. It looks a little different. Whoop. Jen, double post. There it is. I have a question. It takes 3 bars for divergence to print, and the Nexgen 25-year-old pullback to large triggers. Do you have to wait for 3 bars before entry? Well, divergence printing isn't a part of that rule, Jen. So the edge trade that you're talking about says, hold on, let's go find it. All right, so here's the rules. If Fibonacci support holds, let the small triggers roll, buy a pullback to the small triggers. So there's your rule. On your small chart, that pullback to the small triggers looks like a pullback to the large triggers here that will be up and gaining strength. So let me put this in the room for you. If you want to put that in your spreadsheet. Yeah, so what we have here is odds favorable momentum down. And what that trigger roll does, let me go to the picture here, is it goes from hoping that it's going to hold to at least getting that first momentum indicator on the large chart telling you that, yeah, there's actually something going on. And it looks very much... Let's see if we can find a good one. Because we're just killing time at this point. Boom, boom, boom. So that if you decide you want to go study it a little bit, let me find what it looks like on a large chart. I'm looking for a good example. I'm going to look at this one. But I think here, this is going to be it right here, Jen. So let me put a square on it. And that's right in the middle of the night, I think. But I'm going to take that square and I'm going to go find it on the small chart. So there's the square. So let's put them together. So if Fibonacci resistance holds and the small triggers roll, there's your pullback right there. And it looks like the large trigger's down. Of course, this one, Jen, I'm sure you noticed it and you're about to point it out in the room, is directly into 4 areas of support. So you still want to have a clear path. But if this path were clear, Jen, that's your entry right there. And it looks just like this. Does that make sense? And that's pretty close to it being. So I love the trade. I mean, Nexgen taught it 25 years ago because it's a good one. Yeah, but see how the large triggers never rolled? No reason to get suckered into a long there. Um, and now we're in 50-50 territory, so kind of cool. Go take a lot of pictures. You're welcome. And I think new users start to stray away from it a little bit. But go back on the large chart, termination, small triggers roll. What's it look like on the smaller, faster chart? Now I'm going to teach you how to study it. Instead of trying to just do it on simulator, how do I burn that pattern into my brain? Boom, boom, boom. Well, that had an awful lot of dancing, didn't it? Is that right? That's right. So your first shot probably would have been right about here. There it is. I did that wrong. That's your first shot, Jen. Right there. As it pulls back, tries to get to those triggers that have rolled. And that's a pretty ugly example. They don't all work. Termination, smalls roll. Sell the pullback. And that one's picture perfect. Do you see it? That's what it should look like. That's your trade, Jen. Pretty cool, right? So that's a good pattern. That's a proven pattern. Whoa, that's a squishy chart. And it's just the first shot. It doesn't guarantee that it's going to win. It just gives you the opportunity to get in a little bit closer to the fib. You're welcome. Thanks for asking questions. Broke that one with all the momentum. Hit the fib. Divergence prints from the fib. And everybody's brain saying, well, that one worked. I'm going to go short. Yeah. Because why would you fight that level of momentum? And I think what happens is we get excited about trades sometimes and we forget, you know, if I take everything off of this chart, this is an old John Novak trick too. If I take everything off of this chart, is anybody going short or going long against that look? I hope the answer is no. I hope the answer is, well, no. There's no way, right? But when you go, oh, but there was a bounce, but there was a divergence, your brain starts saying, man, let's go against it. Let's hope that it holds. Let's see what happens. And if, because this one broke, you tried to go short here, you've probably already been stopped out. So it's consistency in rules. And now, Jen, check it out. Termination condition holds. Small triggers roll. Notice that it looks like the large trigger's rolling as well. Andy, that is freaking adorable. Oh, little babies. That's a baby having babies. Kids look so young to me now. Good job, Andy. All right. Miss Trina has a couple. And And Trina, that was the first one. We already saw that brilliance. And then didn't check your path. Actually, you know what? I think you did. Will you guys excuse me 1 second? I will be right back. My apologies. All right, guys, I'm back. All right, so Trina, let's check it out. You say weak bottom because it didn't quite hit the fib, right? Odds favorable. You want to see how smart you are, Trina? You said that you didn't check your path. It was right into the fib. But Trina, if you're going to call that weak because it didn't hit the fib, you can't say that that's right into the fib. You're still 3 ticks below it. And your small triggers have smashed here. It's a 50-50, isn't it? 50% of your triggers are through, 50% are not. You have odds favorable momentum. You had no divergence. You take the perfect entry, and you get paid. Trina, this is the perfect 50-50 trade, 100%. Nicely done. Brilliant execution. Does that make sense? Well, sure, but half the triggers are through and half are not. Isn't that a 50-50? Good stuff. And with no divergence and strong triggers and a tiny little entry area, that's worth a shot, wouldn't you agree? Look at that sniper-like entry. Trina, you bought it on the low tick. Once that reversal bar printed, you had $20 of risk on that trade per contract. That's amazing. Who's that? Look at these babies. I love it. That's your youngest? That's so awesome. Your youngest is 31. I think you've got me by a decade. My youngest is 20. He'll be 21 in a couple months. I like it when you guys share the family pictures. And then Joel, I like this. Odds favorable, wide triggers, 50-50, perfect entry, making money, divergence prints on the 50-50, and you take the exit. Joel, 100% flawless. Great, great execution. Nicely done. You guys are making me proud. Working on some NASDAQ observations. With wick reversal bar, low taken out with both large and small triggers down, hard enter when bar low taken out. Piggyback triggers. So all you have here, what chart is that? That's your large chart? So Steve, what do you have? You have a strong trending market. You have a pullback that fails, probably in an area on a smaller, faster chart. Maybe a mid-band. And it's a trend trade, and then it happens again. And then eventually that strong trending market fails. That's at 846. Good observations. So how are you entering it? You're entering it on the way down? Third grade. Nice job, Wayne. Is that Grandpa's Corvette? Sell stop at the bottom of the bar when it forms the bar, you're sell stopping. Oops. I lost my classroom. There it is. Not Grandpa's Corvette? That's all right. I keep telling my wife I'm going to buy a Corvette, but I don't think my spine would let me get in and out of it. All right, Alex, let's take a look. Odds favorable momentum, love it. So why is it a good bottom, not great? Alex, do you want to see how important I find language to be real quick? I'm gonna put a definition at the top. A strong bottom is defined as a termination condition that reverses the market. Is that your definition as well? Just so that we're consistent. Okay, so let's take this a step further. Price reached Fibonacci support. Triggers didn't break. It reversed the market. See that blue line on your fib, Alex? That's your strong bottom. The divergence is just, not only is it a strong bottom, but the buyers also stole momentum from the sellers there. That's like extra giddy up. I love it. And sometimes we'll get caught up in a moment where we're like, oh no, that doesn't fit the rules, and you focus on the wrong thing. But yeah, 100%. So then you get odds favorable momentum and the potential to break, which is perfect. And over here, I see you put your market flow back on. You have an area. So you're going to try the momentum, and if the momentum fails, you'll take it as a trend trade. Is that about right? You're going to take it as the momentum trade, and if momentum fails, you're willing to take it as a trend trade. I like it. That's having a plan. Let me read everything. In between large charts, not sure what to do in this instance. 50-50. It's up to you. Missed this, must have gotten up for a cup of coffee. Yeah, maybe. So let's see what the after is. You catch the momentum trade, and it never gives you the trend trade. And it didn't matter because you made money on the momentum trade. Strong bottom, odds favorable momentum, potential to break. You catch the momentum trade. You're willing to take it as a trend trade. It never produces, and just rock start it. Great job, dude. I love it. I mean, what a great trade. When you understand both options, when you understand that first it's a momentum trade, but with that look, a failed momentum trade becomes a trend trade, why not add on? And I guess what you could do, so you don't waste that contract, is maybe when you get the up bar, just capitalize on that momentum trade a little more. This is such a great trade. Nicely done. So there's that strong bottom. That looks familiar, doesn't it? And there's that odds favorable momentum. And there's the clear path. And, whoops. And there's my entry 2 ticks above the highest point of support. What do you guys think? Does it qualify? Termination, strong bottom, odds favorable, clear path. And guys, I have an area most likely to stop the market and create a bounce that is 1 tick wide. Does everybody see? This is what it looks like before you entered a high probability trend trade. How do I know it's a high probability trend trade? Well, because my large chart has strong triggers. And my large chart has a clear path. And my small chart has areas inside of triggers for entry. And that's the recipe. In Morgan, because of the strong bottom, because it's coming from a termination condition, even less likely for that mid-band to cause problems. Do you see it? And Wayne, that car is beautiful. The old Cobra. Little go-kart. And let me guess, you're putting about 500 horsepower at the rear wheel? All right, there's our entry. My stop has to go where the market shouldn't. My targets are in place. KISS plan. If I enter at the area inside of favorable large triggers, then my stop goes where the market shouldn't. That's ridiculous. If I get a reversal bar, I will reduce my risk to 2 ticks below. Trading the KISS plan, guys. You can even click on it and have it set. 1, 2. If it hits that reversal bar marker, we're reducing risk, guys. Boom. Well, it hit it and hit our first target. Now on break even. This is your KISS plan. Give me a Y if you're with me so far. Nothing to do. It either hits my second target or takes me out break even. I mean, that's it, right? Feels easy to me. I've been doing this for a while. Once you learn your patterns, you're good. Don't get caught up in this fluctuation. It'll drive you nuts. 3 pounds per horsepower. 5. That's crazy. That's awesome, Wayne. So we're going to stay in the KISS plan, guys. Are there any questions about why the entry was taken where it was at? Are there any questions about why we're break even? Why we took a quick $100? Is break even the best stop? Probably not. Because if it pulls back to my break even stop, isn't it just pulling back to an area inside of favorable large triggers with odds favorable momentum and a clear path? Can we just start the rigmarole over? Does that make sense, everybody? I still have odds favorable momentum. I still have a clear path. I still have areas inside of triggers. The KISS plan said get out at break even. The KISS plan doesn't say don't take the next trade if it sets up. My job is to follow my rules. And we'll see what happens. We're back to if then. If I get a reversal bar, then my new stop will be 2 ticks, 1, 2, below it. Let's see what happens. Let's see if momentum and path wins out here, or if the indecision in the market has created challenges. This is kind of fun when we get to do this live. Does it make sense why there was a re-entry? I already made $100. I love that. I still have all of my advantages. It's still a strong bottom. It's still odds favorable momentum. It's still a clear path. It's still a pattern that wins more than it loses. Doesn't guarantee a win though. That's the thing. Just means I have a fighting chance. Any questions? And guys, this isn't me telling you to take trades. This is me saying that the rules are met for a trade. That's it. giving you a visual and a live scenario. And what's funny is we've already made $100 and exited a position, and this is our second trade off the same advantages. So let's see if we can get that reversal bar and reduce our risk a little bit. 1, 2. Just need one more tick. Oh, and it didn't give it to me. Those sons of guns. But I'm not going to deviate from the KISS plan. I'm not going to do it. I'm learning to trust. I'm learning to recognize where the market shouldn't go. I'm learning to embrace momentum. I'm learning to be happy with whatever the market gives me, because I'm not in control of whether or not it gives me a win or a loss. And if you watch the fluctuations, if you watch those ticks go up and down, it will drive you mad. How often is this trade going to lose, guys? What do you think? 20 to 30% of the time, right? Nobody ever sends out a message that says, hey, this is your 20 to 30%. Nobody ever sends out a message and says, this is the one that's going to lose, skip it. Your job is to take it. If the rules are met, take the trade. Are we getting close to the reversal bar marker again? They're trying, aren't they? I'm so glad it didn't jump out because of a 2-tick fluctuation. We'll see what they do. One, two. Come on, reversal bar. It's hard when it's slow, isn't it? Is anybody second guessing it? Oh, it's too slow. It's too slow. Just take money. Get out. Get out, Mark. Take a contract. Take one off. No way. Can't make me. I have a plan. My plan is a good plan. My plan is a proven plan. My plan wins more than it loses. Boy, they're flirting, aren't they? Up, up, one more tick, one more tick. That's all I need. Just one tick. Man, I'm questioning everything. All my life choices. This is fun. What's funny though is when you trust your rules, guys, when you've proven they win more than they lose, when you've gone through the time to do the study, to take the trades, to post the pictures, to circle the tails, it's a pretty emotionless thing. You really, I just don't care what happens next. My brother used to say that to me. I don't care what happens, Mark. It's the right trade. And it floored me. I couldn't imagine not caring if a trade won or lost. But if you study enough, you realize that it's okay to lose every now and then. It's okay to not always have winners. Are there any questions about why I'm doing what I'm doing here? Why I didn't take profits yet? Why I didn't move my stop yet? I'm just following the KISS plan. That's all I'm doing. I'm following the plan that's been proven to win more than it loses. And guys, just a reminder, while this thing sits and does absolutely nothing, Friday is Good Friday. There will be no class on Friday. I'll probably be around. I don't know. The markets aren't trading. If I can find a tea time early, I'll probably find a tea time instead of spending time in front of the markets. Man, that's like the 4th time they've gotten one tick away from the reversal bar. I should just close this out, right? It's clearly not going to go up. Go hide those eggs. Man. Jen, you listened to Mark Douglas, and he taught a trader who got out early to stare at a wall and not look as long as stops and targets are in place. I love it. He has a thing that says that all pain, there it is. There's our reversal bar, guys. Now we have 5 ticks of risk. All pain is self-inflicted. Pain in the market is self-inflicted. All there is up and down ticks, right? You create your pain based on your expectations. I don't have expectations. I don't know if this is going to win or going to lose. I don't know if it's going to go up or down. I don't know if I'm going to get stopped out or if it's going to blow through my second target. The only thing I'm sure of is that my plan says if I get a reversal bar, get my stop 2 ticks below it because it's told me that it's going up. And I feel like if they can break above those small triggers, I should be pretty good. I'm just waiting. There we go. Steve, I think that's a repost, brother. And I sent you a little message. Did you get it? Uh-oh, they're coming for me. Check your DMs. What's cool, though, is my stop is still below areas inside of triggers. Man. Technically, my rules are still met, but my plan says hang out, do nothing, wait, see what happens. And even if I take a 5-tick loser, I'm still up $100 on the other one. No, but I'm following the KISS plan, Wayne. Is that the best stop? Probably not. But I'm following the KISS plan. I already had my entry. I already got my reversal bar. I'm 2 ticks behind it. If it takes me out, who knows? Maybe I'll enter on a confirmation bar. There we go. I'm out. So now I might say, all right, I've already tried twice. I already got 2 reversal bars. It failed twice. I'm okay not taking the next trade. But this is why taking the correct trades is so important. Don't let it happen and second guess it. Don't let it happen again and second guess it. Because the more this dances, the less likely it becomes to win. That's it. No worries, Steve. That happens sometimes. Everything says down, the momentum is there, the path is clear, and you just capitalize. It doesn't have to be hard, does it? Are you learning how to trade one chart? Yep. Are we friends on... I put a... I lost the room again. What do these look like on the small chart? They're just trend trades, right? I guarantee there's some common threads through there. I like this though. If this works for you, this is awesome. You're just slowing down that market more and more and more. Good stuff. Good stuff. What do you guys want to talk about? Whoops, sorry. That's okay. You got an email. Jen, you got to run. Thanks for today. You're so welcome. Thank you for being here. Thank you for being here. I don't know if you guys know this, but when you ask questions, hey, look at that. 3 divergences in the same price range. When you guys ask questions in the room, it makes it a better class. When you post pictures in the room, it makes it a better class. When you post your trades and give us something to talk about, it makes it a better class. And I'm so thankful for all the work that you guys put into this, because it makes me look smart every now and then, which is pretty cool. I need that in my life. I'm going to end the